Hi, this is Jim Cunningham, and we're going to talk about what to expect with markets leading up to a presidential election. Now, if you're like me, I always wonder, hey, what's going on? Presidential election, we don't know who's going to be president after an election. I mean, we all want our guy or gal, I guess, in this election cycle to be the one to be in office in 2025, but we don't really know who that's going to be. And does it matter, right? I mean, this is a really interesting question. I mean, broadly speaking, does it matter if a Republican or a Democrat is in the White House or a Republican or Democrat has control of Congress? Great question. So Christina Lindsay is joining me here today, and we're going to talk about it. Does it matter? And I don't know. Is there a yes or a no answer to this, Christina?
No, ultimately, there's really not. As much as a president can certainly influence fiscal policy, the makeup of the House, the Congress, and fiscal policy has more impact. However, if we really look back in history, I think the underlying theme is if you didn't invest under Clinton, you lost money. If you didn't invest under Bush, you lost money. If you didn't invest under Obama, you lost money. If you didn't invest under Trump, you lost money. If you didn't invest under Biden, you lost money. So the point is to really let your politics drive your ballot, not your portfolio. So we're going to kind of dig into that a little bit more.
Yeah, and this is really politics agnostic. We're looking at numbers, and I don't think the numbers really care. I mean, numbers are just numbers, right? It's just
Uh,
math.
Yeah, as much
But
as
the
people would
lawyers,
like to think that a president has a lot to do with the portfolio and the markets, it just doesn't.
yeah.
So we're going to kind of dig into that a bit more.
And if any of you know a lawyer, and this is true especially with personal injury lawyers, lawyers are really notoriously bad at math unless you can ask any personal injury lawyer to divide any number by three, and they're going to get it down to the penny. I just want you to know that. So, a little bit of humor. Okay, so are interest rates cuts signaling a market shift ahead, right? So we've had a recent, and we're doing this in October of 2024. We've had a recent interest rate cut. And how do the proposed economic policies impact your financial future? Does it matter if we have a Harris administration or a Trump administration? What does that look like purely from an economic standpoint? So we're not talking social policy, we're not talking all that stuff. We're talking about your investments, the money that you've got in your IRA, your 401k, the money that you might have invested in a trust for your family, money that you might just have in savings, right? And a lot of people, I would say most of our clients, Christina, and I know by definition your clients are savers. These are people who
Mhm.
could go out and buy whatever car they wanted, broadly speaking. They could buy boats and planes and whatever it is, but they choose to kind of live below their means and spend less than they have. So if that's not you, um, I mean, this may be useful, but I think most of our clients are spending significantly less than they're earning. Well, I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've got over 30 years experience. We have offices throughout California. I'm a certified specialist in estate planning, trust and probate law, real estate broker, and securities and insurance licensed, and a pilot single engine land instrument rated. I have a little over 1,000 hours in a Cherokee 6, which I used to call flying for dummies because the landing gear is welded to the aircraft. You don't have to put your wheels down. These are the lawyers in our firm. We are focused on all things wealth creation, transfer from one generation to the next, family owned businesses, and real estate. So we have a lot of clients with real estate portfolios or businesses or just have a lot of portfolio assets. And this is the team at Ascent Wealth Management. And this is Christina. You're joining us. And there are two other people that are your partners. Who
Yep.
are these people?
Yep. We've got Shannon, who's our COO, and Alyssa Kroger, who's one of our other CFPs. So we're all partners and owners in Ascent, and we are all certified financial planners. We are all also accredited estate planners, which looks like we need to update that to show our designations up there. But we all have a focus on estate planning. This is ours. Okay,
Yeah,
yes.
that's
I'm
yours.
like, which disclosure? Which disclosure is this? Is this mine or yours?
Yeah,
Because we both
you have
have
two.
disclosures. Yeah, this we have to give the disclosure that we are securities licensed. We also are registered with both FINRA and the SEC. And so anything that we talk about is not a guarantee. We're not talking about any particular product or promoting any particular type of investments. We are going to talk about the Fed and when they start a rate cut cycle, what that typically does to the stock market and different bond indices, what that does to the bond market. So we're going to take a closer look at certain market trends and talk about historical performance in presidential election years. But again, nothing is as a guarantee of future performance. So, and again, kind of just offering securities we offer through Cambridge Investment Research. We have our own RIA registered through the SEC. And again, investments do involve risk, and this is not a promotion of any particular security. We want to make sure that any particular investments that are done with our clients are done in their best interest, and it's done on an individualized basis.
And here's ours, which is this. I'm a lawyer. I'm talking. This is not legal advice. When I say you, there is no attorney-client relationship attaching. The bottom line is don't watch this and go out and do a bunch of stuff because I was talking. So it's not legal advice. Definitely you need to get a competent lawyer. So now that the disclaimers are thankfully out of the way, should we mix politics and investing? What are your thoughts on that, Christina?
It's a great question. So I think this is probably the overwhelming conversation that I'm having with clients, especially not necessarily those that have got money already invested, but those that have got maybe some additional cash or some additional windfall or money on the sidelines, or they recently retired and they've done a rollover or something where they might have additional cash not currently in the market of, I don't know, I just want to kind of like pause, or should I pull out of the market? What should I do? I'm just uncertain about what's going to happen with the election. And so I think that the underlying theme here is your portfolio should not be driven by political decisions. And so this goes back to my comment at the beginning that if you chose to sit on the sidelines during a particular administration that you didn't politically agree with, you ultimately were the one that lost. And so in pretty much every presidential cycle, there's money to be made. There might be different types of investments that we look at. There might be different fiscal policy that influences our portfolio allocation. But if you're completely on the sidelines, ultimately, the only person that lost was the investor. So,
And I'm looking here during the Nixon administration between 68 and 76, Nixon and Ford. I would say that is where the Bretton Woods kind of fell apart. That's where the U.S. went off the gold standard. A big deal happened then, and I think if you subtract that out, that sort of sideways movement, and that was kind of a dead, kind of almost like a lost decade, right, for stocks in that 68 to 70, really, 68
yeah.
through 80.
And even
Um,
though that was a kind of more sideways period, there were still value stocks and
right.
bonds and places to invest. So ultimately, the biggest loser was cash. Cash with inflation is the worst place to hide out in.
Especially from 68 to 76. I mean, that's
Hmm.
when I was a kid, you know, I saw inflation growing up in the 70s. It was crazy.
Hmm.
Prices just kept going up and up and up. And then we haven't had that. And then we had it recently, right? So for those of you who may have never even seen inflation until we had it in the last couple of years, it is a shock to see that, you go to the store and everything's 30% more. And for those people who are really living paycheck to paycheck, or not, or just paying attention to prices, we've had this big surge in inflation that thankfully it looks like it's cooling off. But interesting chart, right?
Correct. Yes. So, ultimately the question becomes, okay, well, but if a Democrat wins or a Republican wins, what does this really mean? And out of the last 23 elections, for presidential elections, so we're just talking not midterms, but presidential elections since the S&P 500 began, 83% of them were positive performance, with the most notable exceptions being following the dot-com crash and the great financial crisis and the subprime lending crisis of 2008. So when we had the housing crisis, very different, obviously set of circumstances. That was a more structural recession where, structurally the whole economy was not in good stead. But those are the only two exceptions. And so while you do see a degree of variance here with returns, the average rate of return in all election years is positive double digits on a presidential election. So you can see, following a Republican getting elected, the average return is 15.3, following a Democrat getting elected is 7.6, but in both cases, positive. So regardless of, whether you're for one party versus another, where there's a pretty equal divide in the nation right now, you shouldn't be on the sidelines just because of fear of who might win following the election.
Yeah, and when getting ready for this, when going over these slides, it's important that if you're looking at watching this on video, what we have here is a slide of returns during the year in which a presidential election occurs. So this is not the term, right? But this
Correct.
happens to be the year that the presidential election occurs. We have actually a very timely question, and we'll leave this in the video because for YouTube, Ashley. But this is from Ricky, and Ricky asks, "Do you think external issues, the war in the Middle East and the longshoreman strike, will have even more of an effect than the election?" I mean, I think based upon what you said, that seems to me that has an effect. I think there's another school of thought that says demographics have a much bigger effect. You know, when do these generations hit their peak spending, and general business cycles? But I think that longshoremen, I mean, maybe you want to speak of that. Will that have an
Yeah,
economic
that's
impact?
more
I
of
mean,
a
I think the answer is yes, right?
Yeah, I think that
Right.
there's current events, and what we will see as we kind of get through some additional content too is that and historically speaking, in any given year of the market for the stock market, I'm just talking the stock S&P 500 index. Um, Historically speaking, September is the most volatile month of the year. And that normally gets pushed to October in a presidential election year. So a lot of volatility headlines leading up to the election. So a lot of the normal September gloom that we see kind of falls into October. Now, headline volatility is really what that is the whole longshoreman strike. Now, certainly, if that were to go on a prolonged, beyond 6 months where we had ships sitting offshore like we did during COVID, that's a different supply chain issue and story. If this is a short term, is it going to impact trade? Yes. Is it more of a headline volatility in the short run? Yes. Is it something to be concerned about at this point? No. I think that, politicians won't figure this out over the next few months. I'm sure that there will be some sort of a coming to an agreement. Even if we looked at the film industry and what happened with the writers' strike and the different what is it, IATSE and Teamsters and all the different unions, there's going to be different, segments of the economy that are certainly feeling more pain. But broadly speaking, does this impact the stock market? No.
How much of this, when we say the stock market and S&P 500, how much of that is domestic and how much is international, broadly speaking? Like how much of the S&P 500 revenue comes from
Yeah, so that's a
outside of the
great
United
question. We're a very global economy. Um, all of the S&P 500 is domestic based companies. So it's not a Samsung or Royal Bank of Canada or something that's outsourced outside of the US. However, revenue can come from multiple places. Microsoft, Apple, they generate revenue globally. So these are still domestic companies, but it'd be very easy to say that these are globally
Right.
driven results.
At least the really big ones, right? The
At
ones.
least the big, the top 20 for sure.
Now we have another question. I'm just going to throw this out here because I did see something on the news recently. Gold is setting in new records. I believe that implies investors are fearful. Should that be? I think is what they're. It looks like a little bit of a typo. Um,
Yeah, let's get into some of the other content.
yeah,
We did do a whole webinar on gold. I would honestly refer you back to that
great.
because I don't think gold is a very good investment to hang out in. We went
I,
off the gold standard a long time ago. There's no yield on gold. The only people that make money on gold is the middleman and the brokers. So I'm going to leave it at that. And
can I just say one thing about gold is I had a client years ago, gosh, probably 20, 25 years ago. He said, never invest in gold. Now, I'm not telling you to invest or not invest. I'm telling you what somebody told me. He was a geologist, an American geologist who worked in South Africa. And he said there are more known gold reserves than it's like way more gold than there is currently kind of extracted and refined. And so as the price goes up, they mine more. So it's we have a whole nother video on that. And I'd encourage
Yeah,
people.
I'd refer back to that one. You and I did a whole webinar on
Yeah.
gold, so I would certainly refer back to that. Corrections during presidential years. So the one thing that I think always makes people fearful during a presidential election year is the volatility. And historically speaking, there is more volatility during an election year. And the average correction intra-year is 14% pullback. I think we saw a lot of the volatility so far for this year in August. There are some other factors I think that drove volatility this year, with being mindful that we entered this year with 6 expected rate cuts that kept getting, the can kept getting, pushed down the road. And so as soon as we did see rate cuts just last month, that was 9 months later, and we're certainly not going to see 6 this year. So I think some of the volatility surrounding that, which we're going to talk about Fed rate cuts later in the presentation, but volatility is normal. Intra-year corrections are normal. They happen every single year, and drawdowns of 5 to 10% are very normal. It's not considered a correction, and getting in past correction territory until it's a 20% pullback or more. So these, 10 to 15% volatile pullbacks are normal, and the snapbacks are very quick.
How quick are they?
We're going to talk about, I think there's a slide that has some of it we'll talk about later in the presentation for sure. But, most of the 5% bounce backs happen in a day. So if you're on the sidelines and you miss that 1 day snapback, the market timers, the Market Timers Hall of Fame is an empty room, because you have to know when to get out and when to get back in. And if you got out and you missed the 5% run up, you are certainly lagging on the overall upside. So kind of what to expect. I mentioned that October is normally where we expect more volatility. There's going to be more headlines. There's going to be more fear. There's going to be more different platform policy, the incumbents, trying to create certain messaging and media headlines. And so there's just normally in an October election, for a presidential election, you're going to expect more volatility. This is what we see the 3-month returns post-election since 1948. So if a Republican wins, we typically see a little bit more euphoria. And if a Democrat wins, we typically see still upside, not quite as much. There's a divergence between the two, but I think that the underlying theme is positive. Like the underlying theme is that we typically see double-digit returns for the calendar year finishing a presidential election. We typically see upside trajectory post-election, and the biggest reason why is because the markets want certainty. The markets really don't care who's in office. The markets want to know what's going to be the makeup, what's going to be the projected fiscal policy, and okay, now we know what we're dealing with. And so that's really the underlying theme.
I really like this graph because it really, to me, if you were to kind of average all these lines together, it shows that the market kind of goes down before the election. And to your point, once we know who the president is, right, then people can make plans, and then the market goes up.
Yeah.
Right. So very, very, very helpful graph.
Exactly. Yeah. So pre-election jitters, as we mentioned, this is the VIX, which is the volatility index, which is a measure of fear, if you will, and consumer sentiment in the market as it pertains to the S&P 500. And so August going into September, and certainly in October, the volatility index is high. In November, while it's still high, it's coming down significantly. And we typically see the least amount of volatility the first year of a presidential term, because regardless of politics, the first year of any presidential term, it's difficult to get a whole lot done. And so the market kind of goes, okay, we got time. And so the market tends to slow down.
So what you're talking about is volatility, meaning the up and down of a stock. If a stock just kind of stays at $10 a share and doesn't move much, it's not volatile. If it goes down to 1 and up to 19, that's a lot of volatility, right? So volatility is ups and downs in stock markets. So when you watch the news and they say, the Dow is down 2% today, and, breaking news, this just in, David Muir looking good, reading the news, right? Which my wife and I watch every evening at 5:30. That's definitely her decision, but she has the remote in her hand. So we're watching David Muir. Why is volatility bad? And maybe talk about volatility and risk in there, because I will tell you, I see people and have seen people when there's a drawdown in the market, which means when stock prices go down, some people panic and they sell. Some
Yep.
people sell, and it's really easy in an IRA. You can say, I'm scared, I'm selling everything, I'm going to do something else that's not stock market when it's down. But why is volatility bad?
Volatility isn't necessarily bad. I think that the question is, do you have the volatility in the right part of your portfolio? So we always talk about asset location. Asset location is critical when it comes to constructing a well-rounded financial plan. So if we have your high growth investments that are going to have more volatility, that's not bad as long as we know that's our 5+ year money. We're not touching that for the next 5 years. So we're okay stomaching volatility. Volatility is not as good when we know this is money that we're going to need in the short term. We're going to need to rely on for distributions. We don't want to be stuck selling something on a 20% pullback. We want to make sure that we've got money in the right spot. So asset location is key. You don't want volatility for stuff you're going to need to pull from in the next couple of years. You're counting on it for distributions. But then we also talk about risk adjusted returns, which we've also done presentations on in the past, but risk adjusted returns matter. Can we get similar returns to an index with less volatility? That would always be our preference. If we can get to the same level of needed return or desired return with a smoother ride, we always are achieving to do that.
I think there are a lot of people who they have an emotional reaction when they look at their statement or their balance. And now you can look at it on your phone and daily going up and down when it used to be like every month or every 3 months.
Mhm.
And if that's you, and if you're having emotional reactions and can't sleep at night, Christina, I would say that person is probably not appropriately invested if it's giving them emotional consternation. I mean, wouldn't you? Because a lot of this it's not really logic; it's tummy factor, right?
Yeah, it's tummy factor, and you really have to, check your tummy factor. And that's really where I tell clients too. If this is your long-term IRA money or your 401k money, and we're not touching it for 5, 10 years,
Yeah.
we can deal with volatility there. But it does come down to risk tolerance too. So this is kind of what I was mentioning, that volatility chart that we saw kind of peaks up in October as we get to November, and then all of a sudden the market kind of goes, okay, we kind of know what to expect. Which you and I are going to do a webinar on November 14th, talking about the outcome of the election and the specific
Right.
makeup of Congress and what to expect, fiscal policy, all of those things. But the underlying trend is less volatility in the first year. The first year of a presidential term is very difficult to get a lot of things done. Things don't move fast through Congress. And so even if you looked at, 2016, when you had a Republican control of Congress, Senate, and executive branch, it still took 2 years to pass a tax code. So things don't happen quickly, even when you have a full control. And most of the time you have split balance. And so the first year post-election, the average volatility cuts significantly down. So this is a measure of 13.5, and we saw stuff reaching up to, 2x that leading up to the election. So we do tend to see less volatility.
What does this percentage mean? You're talking about annualized realized volatility of the S&P 500. So that means like the S&P 500 is going
Mhm.
up or down 13.5% or up 13.5 and down 13.5.
It's kind of one standard deviation movement. It's a measure of the VIX. So the volatility index, as we saw on the previous screen, kind of goes up to the low 20s and mid 20s on the index score, and it goes down to 13. And it's about a one standard deviation movement. So I know we're getting technical, but what it means is about 68% of the time the market's going to fall. If it's 13.5%, it's going to fall within 13.5% to the positive or negative of the average.
Okay. But
So
the other time it's going to be outside that, up or down. So,
yeah,
okay.
and so we're in a greater volatility spread right now.
And so for people who have tummy factor issues and they're invested in things that are volatile, it's going to be
It's going to be
less
bumpy
rocky.
probably for the next,
Right.
30 to 45
Right.
days.
Right.
So, but 1 year returns post-election, this is really why you don't want to be on the sidelines, is the average returns on the stock market post-election for the first 12 months following the presidential election are on average up 9.4%. So again, with the exception being oil embargo and the 9/11 attacks. So very few exceptions to the rule. And so then it gets into, okay, what about the makeup? and we'll talk more about this when we have our final outcome of this election, a little over a month from now. And, the split makeup is typically the best. So when we have some sort of balance in power is typically where we see better returns. And so, it's very rare to see a complete sweep of, Congress and having the president administration be, all the same. So this is kind of the historical average from 1949 through 2023 of what we can see historically.
It's almost like do no harm, right? It's like
Yeah, again,
when the
don't sit on the
government has less
sidelines.
power, we do better. I mean, that's
Yeah.
kind of an interesting takeaway, right?
Hmm.
All right, let's talk about the Fed. By the way, the Federal Reserve is an unelected body. As you may not know this, it is not like run by the federal government. It's independent of the government, and some people have criticized that, and some people think it's a great idea. But the Fed is the institution that sets interest rates, which has an outsized effect. I mean, it's like the Supreme Court's an unelected body. You got five people deciding for 330 million. You got the Fed, which is a group with a 12 Federal Reserve banks plus a chairman is at 13. So you got 13 people deciding for 330 million people,
Hmm.
deciding how much you'll pay on your credit card bill. You can agree or disagree with that. That's the reality. So let's talk about the Fed and what they typically do in an election year.
Yeah, I mean, so I think what we really want to highlight is the Fed once they start cutting. And we know just with the economic cycle, they're kind of going to be towards the cutting side of things. We're not in this hiking cycle like we saw in 2022. And so, um, you know, there's still some dissent on the Fed committee as to whether or not we should have done a half or a quarter, or if we should have hiked yet or started cutting yet. Sorry. Um, and truly, the economic data is not suggestive of a need of a cut. We still have very strong consumer. We still have very strong job market. The job market was softening, but not soft. So there really wasn't an economic reason to start cutting, but I think the Fed also wanted to appease either party coming out of this election. And so they're not supposed to meddle in the elections, whether you consider, say they did or didn't. What we're here to talk about is really what happens when they start cutting. And
Yeah.
so regardless of whether or not they should have cut now, whether it should have been a quarter, whether it should have been a half, we're in a cutting cycle. And so what happens historically when the Fed starts cutting is the cost of funds gets easier. It helps shore up some balance sheets of corporations. They know that they can borrow at a lower interest rate. And that ultimately helps most of the time the stock price. And at the end of the day, the stock market is driven by price earnings ratios. And as long as stock and companies and corporations are making money, the price of their stock goes up. So this is just historically what we can see in election years with Fed cuts. And I don't know how relevant this slide particularly is when we know we're going into a cutting cycle. So what I want to kind of drill down on is what happens post cuts. And nope. Um, Part of what is kind of unspoken here is the M2 money supply. And
All right, you got to explain what is M2.
yeah, the amount of capital out there. So what happened during, COVID was all this quantitative easing and printing of money and just stimulus, spend, spend, spend. And so what should have, basically what could have happened during 2020 had the Fed and the government not stepped in, we're kind of seeing that delayed factor of what took place in 2022. The pain that could have been realized in 2020 just got felt later because at some point we just kicked the can down the road that we had to deal with the tightening money supply. So even though we are going into a cutting cycle, that the money supply is still very tight. And we still have a very, very healthy balance sheet. So there's still a lot of reserves that the Fed is sitting on, and our balance sheet is still quite significant. And we, as there's been some communication about whether or not we're going to run into debt greater with a higher interest rate market. Yeah, is it a concern eventually? Is it a concern today? No. We went in 2008. What you can see here is that we went from a scarce reserve monetary policy to an abundant reserve monetary policy. So there's some white papers on that. We can certainly get that out to you. Brian Westbury does a great job about talking about the supply of money. He writes for First Trust. He's on CNBC quite often, but our balance sheets are still pretty healthy. So I think that that's kind of one of the themes that we want to reassure people too, is that we have a strong Fed, we have a strong balance sheet, the supply of money is still tight. And as they cut interest rates, that should loosen a bit. But I don't expect us to go into a really low interest rate environment. And I don't expect the Fed to cut to zero for any reason right now.
Well, and I think it is worth mentioning that if we go back to a zero interest rate environment, something is going wrong.
Is wrong. Right.
That is not a good thing. Okay. So
Right.
just to be clear, you say, oh, it'd be great if, we could go back to 2.75% mortgages. That means there's something really bad going, there's another pandemic, there's some other global financial crisis like we had in 2008. That is not good news. Okay.
Right.
So, well, let's say someone is watching this and they say, gee, I'd like to buy my first home, or maybe it's a parent or a grandparent, and they're talking to their kids about buying a home. When is a good time to buy a home?
It depends. I think real estate is always an area too where location matters. And at least in California, we're still supply constrained. The prices we're not seeing a sign of a real estate pullback or correction. And so it's just a matter of what you can afford. Do I think interest rates are going to come down a bit more over the next 12 to 18 months? Sure. Do I think it's going to go significantly lower too? I think that we're going to be in a range of 4 to 4.5%. If I had to guess, we're going to probably be in a higher range of federal funds rate for a longer period of time. I think we're in a higher for longer environment while we're still cutting.
Interesting. Yeah, that's a tough one because I know a lot of people a lot of our clients, they're really thinking about, gee, it'd be nice to buy or help my grandkid or kid buy a house so that I can see my grandkids or great grandkids. But I was just watching something this morning about, oh, maybe, we'll see a 5 on the interest rate soon. They'll get sub 6, this calendar year. Who knows? But remember, if you're thinking about buying, and I'm talking specifically a home, not an investment property, but a place that you're going to live in. I'm kind of in the camp of it makes sense to buy it. I mean, it's almost like independent of interest rates because if it goes down, you can always refinance out of that higher interest rate loan. So I don't know. You got to live somewhere. Okay.
So, it's always hard to predict where the puck is going because the Fed's been so wrong on their yield curve for the last couple of years. So this is the current implied.
Yeah, what are we looking
cycle.
at here? What is this implied? Is this percentage here like 5.33? What is this?
This is the current published rate cut expectation. And so this is what the market is pricing in. And so this was obviously just right before the September cut. This was as of August 30th. And so, we're kind of at that 5% roughly federal funds rate. This is the expectation of where that puck is going over the course of the next couple of years. So you kind of mentioned, okay, well, when should someone buy a house? Well, I mean, nothing on here is going below 3 on a federal funds rate in any of their projections. So this is, will we drop into the 3s? Their projection is probably late 2025. If I had to err on the side of caution, because the Fed has been so wrong on their, yield curve leading into the rate hike cycle, inflation was not transitory. It was here to stay. They had to keep making adjustments. So if I had to be more conservative, I would say maybe push this out a little bit longer. Maybe it doesn't go quite as low. That I would err on the side of conservatism, just because the Fed has been a little bit too optimistic, I think. And so nonetheless, this is the current outlook. We know we're heading into cuts. We're not heading into hikes. So whether this be the bottoming out at 3 or whether it be 3.5, the point being we're in the downward trend. So let's take a look at what happens when the Fed starts cutting. We're going to kind of look at a couple indices and what we normally
Yeah, I have
see.
a question. So uh, if you look into your financial crystal ball, you're paying attention to this. This is your profession.
Mhm.
So what you're saying is mortgage rates kind of in the high fours, low fives, mid fours. So you're basically adding 175 basis points to these numbers at the bottom. Is that kind of it ish, more or less? Is that the spread?
Yeah, I mean, you're typically looking at the 30-year treasury. Mm.
Okay. Oh, CDs.
Um,
You know what? I got to tell you,
yeah.
it's been
Mhm.
really good lately. For those of you who have cash, wow, you're actually getting interest on your CD.
Yeah,
But
it's
I
getting ready
think
to
the party
change.
is the party over.
Yeah.
Okay.
So that's really, I think the underlying message too here is that we enjoyed a pretty nice run and finally got paid to have reserves in CDs and treasuries. And so, we've spoken about this before too, but I am not a fan of CDs for high net worth earners because they're taxable at both the state and the federal level. So if we're in treasuries, we're able to get basically the same guarantee from the federal government as a treasury. It's just not FDIC insured. It's a treasury guarantee. And
A
so
little
it's
bit
backed by
better. It's a little
it,
bit better than FDIC
it's
insurance.
actually better than FDIC. And then it's not state taxable. So
Right.
we typically get a higher rate and save taxes. And if you're in California and you're in a double digit tax bracket, most of our clients are between a 9 and 13% tax bracket in the state of California. You can at least save that on a treasury. And then you have municipal bonds that are really attractive and they're state tax free and federally tax free. They typically require a little bit longer term duration, but they are also very attractive for locking in a higher interest rate right now. So has the party, is there still an opportunity to get into the party? Yes, with municipal bonds, yes, with treasuries. CDs and money market rates are going to start coming down. And so I would say before we're in that low interest rate market, don't wait to reposition cash, money market, CDs. Those rates are coming down. And so it's time to start looking out further and repositioning that money more efficiently. So after the Fed cuts, this is talking about 12 months after the first cut. So our first cut took place last month. So 12 months after that, we typically see money markets go down. We also see short-term bonds come down, and we see intermediate core bond rates come down. But core bonds, government bonds, tend to do better than money markets.
We have some questions. I'm looking at these. I think these are normally we wait till the end, but I'd like to ask these questions, Christina, if you don't
Sure.
mind. So Anita asks, it appears that the market ups and downs, gains and losses is not dependent on who the political side is in power or what election events offer. It's what happens in the world in general with little political control. Would this be said a correct understanding of what Lindsay Orta said? Uh,
Yeah, I mean,
yeah.
fiscal policy does impact the markets. And so broadly speaking, yes, who's in power and who wins the presidential election is not going to have a huge impact on the stock market. It's more
It,
driven by, I wouldn't say necessarily driven by global events. Certainly there could be global macro crises,
yeah,
but as we've even seen, like Ukraine, Russia hasn't really moved the needle.
yeah.
The Israel Hamas conflict has not really moved the needle for the stock market. So unless there's like huge impacts, global events still would be questionable. They're usually short-term headline trends, but underlying economic fundamentals, fiscal policy, that's really what drives the market.
And John says the chart stops at, this is the first one we did on returns during a presidential election. Chart stops at 2016. What about 2020? I think 2020, the stock market went way up. It was like,
Yeah, we actually showed that in one of the other
we
charts. We
did. It was
did
like,
show it.
was it 70% or I don't know, whatever it was.
No, but we did show it. It showed through 2023.
Okay. And then Anita asked, does Christina believe the volatility of rates will continue until about 2028? Interesting.
Volatility of rates, I don't see as much volatility because typically what happens when the Fed is raising rates, the value of bonds or CDs or, treasury, like the value of a debt security or a bond tends to go down significantly when you're in this hiking cycle. As you're kind of going into this cutting cycle, the value of bonds go up. It's a seesaw inverse relationship. So the volatility should be to the positive side on the par value of the bond, the underlying value, what it shows on your statement. But I kind of go back to this analogy of, when you own a dairy cow, you own a bond for the purpose of producing milk every single day. You're buying it for the yield and the coupon. You're not buying it for the price of beef.
Right.
And so while the price it was certainly volatile. The price of bonds was absolutely volatile in 2022. The volatility isn't quite so significant, but you do see appreciation typically in a cutting cycle.
Yeah, I would say most of our clients and your clients, Christina, hold bonds until maturity. That's kind of
Correct.
there's
Yeah.
no reason to sell it because you're just there's just friction and you're incurring a cost that just doesn't make sense. You might as well keep it. So Elaine
Right.
asks, how low do mortgage interest go down and when does it stop and go up? Okay, so we're talking about interest rates going down. Is there a forecast of when they're going to go up? I've not seen anything on that.
We've not seen any indication. There would need to be a particular reason for it to go back up. And right now there's nothing in the headlines or data that would suggest the need for that.
How much concern should an investor have about the national debt level? 35 trillion.
Yeah,
Interesting.
I mean, it is a concern long term, but it kind of goes back to, again, the Fed has abundant reserves. We went to this abundant reserve
Yeah.
policy after Dodd-Frank and after the '08 subprime lending crisis, and so the Fed has reserves. If they change fiscal policy to go to a more scarce reserve policy, what they're trying to do too is prevent the bank failures and all the the lean balance sheets that banks and everyone ran off of during the '08 housing crisis. But we do have the reserves. If it, is the debt a problem long term? Yes. Is the Fed going to have, or sorry, is Congress going to have to do something with Medicare, Social Security, that third rail that no politician wants to touch? Eventually, they're going to have to. Is it a problem that typically is going to affect, the current today, those that are on Social Security? No.
Yeah.
Can
Unfortunately,
they
it's like time to run out when I get my Social Security. Is like literally the month I get it is like when it's scheduled to fall apart.
and
Whatever.
even at that, these minor changes that we would have to make, if you were to just increase the amount of taxable wages, increase the percentage a little bit that gets contributed to Social Security, these aren't major changes to fix the problem.
The other,
This,
yeah,
the
the,
spending problem and having a balanced budget we haven't had since Clinton. So
yeah.
it's both parties are guilty of spending too much money, and eventually we're going to have some people that know how to balance a budget in Congress.
So the other thing that happened is during COVID, the government borrowed a whole bunch of money and passed it out. And what ended up happening is a lot of people paid down debt. So that debt went from the private space to the public space. So when you look broadly speaking, yes, it's a lot, and a lot of that debt that the government took on was basically a wealth transfer to Americans,
Yeah.
and now we're dealing with that. All right,
Yep.
Anita says, is there a portfolio balance direction you can share to balance a portfolio for 80-year-olds or over 80-year-olds with not possible living 5 more years? What is an octogenarian who's not going to live 5 more years? What is the basic investment strategy? Great question.
It's a great question, and it depends on your needs,
Yeah.
your goals. Is your goals for income? Is it for legacy wealth transfer? What are we dealing with comprehensively at the entire individual and financial plan level? So I think simply speaking, the message being, it's great to get into some bonds right now while the interest rates are still kind of at peak or near peak. We're just barely entering the cut cycle. So we can all agree whether we are, at the peak or we were at the peak a month ago, we're still near the top. So if there is such thing as timing the market for bonds, it's still a really good time. And so if you can lock in something for 5, 10 years, we're putting some clients in municipal bonds that we're able to protect the current interest rate yield of 4.5%, 5% until 20 to 34. So we can do 10 years of protecting, locking in a particular high yield for a good period of time. So if you're looking for safety and high yield, you can get that right now.
And then question is if as mortgage rates come down, prices go up, and so that is the adage of buy now and refi to a better rate later. And then Thomas asks, so where would you put short-term cash reserves? And I would define short-term as 2 years or less, correct? Would that be
Yeah,
short-term?
short term depends. Again, if it's truly, truly short term, less than 90 days, I would say money market for sure. But and money market's still better than sitting in savings in a checking or savings account. However, looking at a treasury even for 6 months or later, again, you're going to avoid the state income tax. I would definitely look at a treasury before a money market or a CD. So it just depends. Equity leadership following the Fed rate cut. So I think that this is also something that's important, because if the political conversation didn't resonate, that politics don't matter when it comes to investing. It affects fiscal policy. Maybe how we design the portfolio is going to be different, which we're going to talk about after the election next month. What could be changing, where we might want to hide out in the market. There's certain, pros and cons, but bottom line being politics don't really matter. What we also see historically following a rate cut is positive stock markets 12 months later. And so the other theme, if you don't buy it and you're just still stuck in your ways of, this, I'm just really concerned with what might happen with the outcome of the presidential election if my party doesn't win. We also have another indicator that historically speaking, 12 months after the first rate cut, the stock market does well on average. And so both bond indices as well as the stock market tends to do well, with the average returns being positive. So this is just another way of looking at that. The US stock market on average being 11% to the positive. That's, your S&P 500, 11% average total return, 12 months following the initial rate cut. Government bonds, 5%, corporate bonds, a little bit better. So if income tax rates aren't a huge concern to you, or you're in a zero state income tax state, corporate bonds tend to be better. But everything is better than cash and money market and CDs. So
Christina, we have a lot of clients who move from New York and New Jersey to California. So for those of you watching this, who this is not you, a lot of people do move to California, believe it or not. There are reasons why people do. And what we see is a lot of people moving from the East Coast to the West Coast. If I have, let's say, $1 million in New York State tax-free bonds, and I become a California resident, what happens to that tax-free income on my New York bond?
yeah, if you own an out-of-state bond and you're in a taxable state, then that state has the right to tax your out-of-state bond. And so, if someone moves from California to Texas, not a big deal. There's no state income tax in Texas. But if someone moves from New York to California, you want to swap those bonds out for a state that you live in.
That's really important. And this is just something to pay attention to. And that's why it's important to talk when you move from one state to another. It's important to talk to your A team, as we call it on other webinars, your CPA, your financial advisor, and your estate planning attorney, because these moves do have consequences. So
Yep.
very, very important if you are moving from one state to another.
Yep. And so the other question we get a lot of times is, but are we heading into a recession? What is it? The doomsday, one of the he's a pontificator on CNBC quite often, and he talks about doomsday, and we're heading to a recession. I think he's predicted 2 of the last 20 recessions he's predicted. So
you're going to be right at some point.
At some point, you're going to be right. And I think Doty from Chapman University, Doty tends to say, if you can't predict something with 60% certainty or greater, it's not a prediction. Yeah. And so you'll see a lot of people hide out and there's a 40% chance or there's a 30% chance. This is ultimately what we look at. We look at the leading economic indicators. And so the LEI data looks at various different segments of the economy. So we look at everything from housing permits to ISM new orders to manufacturing orders to profit margins to jobless claims to job sentiment to wage growth. And so I think what we can see here is, while there was even some potential caution in March, inflation's come down, wage growth is still decent. We've got consumer spending still going. And so we're actually starting to see more expansionary indicators as opposed to more recessionary indicators.
What
So
yeah, what's job sentiment?
yeah, the overall it's through like polling of ADP and payroll data of just like based on the amount of payroll temp versus full-time, what the overall sentiment from the payroll companies is based on, are we seeing hiring or are we seeing layoffs? So that's kind of what we're
Yeah,
seeing.
because it's three recession indicators on your slide here. So is the yield curve, and I'm puzzled by the yield curve. In many ways, coming out of COVID was like coming out of a war because everyone was at home, people weren't out doing a lot of stuff necessarily, and that may be the explanation of the yield curve because we've been hearing Christina for a couple of years now. Oh, the yield curve is indicating that there's going to be a recession, and it has not materialized.
And the yield curve, quite frankly, tends to correct itself once we go back into this cutting cycle. So the yield curve being inverted isn't expected to be a long-term trend. It kind of corrects itself as we start going into a cutting cycle. So we don't pay a whole lot of attention to that right now.
I'm really glad to see wage growth is up. And that's really, really important because the more money that consumers have, the more they can spend, which is 70% of the economy. So it's good when wages grow. Now, if you're a business owner and have to pay your people more, you might be complaining. But at some point, you have to get over it because it's better if people are making more money because the economy does better. I mean, it's,
Mhm.
showing a potential expansion. So, all right.
Mhm. So we talked about this during election years, and I think this is important to go in general, not just election years. The stock market has volatility,
Hmm.
period. And so there's no such thing as timing the market. You can have certain types of protection features in your portfolio, but volatility is normal, intra-year declines are normal. And so the blue being how much we see the market fall within a year. So for even 2008 as an example, it fell 49%. It finished the year down 38. In 2020, the market fell as much as 34%. It finished up 16. In 2022, the market still finished down 19. It pulled back as much as 25. So pullbacks are normal. Intra-year volatility is normal. And despite that, the market is positive 22 out of 31 years. And so most of the time, the market recovers. 4 out of every 5 years are positive. So as long as you have time on your side, it comes down to asset location. Do you have the right assets in the right bucket? And can you what's your time horizon? So I want to make
I'm
sure that we
thinking, and this may be because I'm 55, and as you get older, you start thinking about, the end of the runway is getting closer, right? As it does. Do you have any words of wisdom for somebody who's retiring? Okay, let's say someone who's 65. They're not going to start their required minimum distributions for 8 years or whatever it is,
Mhm.
7, 8 years. They're
73. Mhm.
65. Should you be invested in the market the first couple of years of retirement or not? Or does it depend? I mean, obviously, I
It
think
depends.
it
Again, we might
depends,
say, okay,
but
you've got $1 million IRA. We need to distribute $10,000 a month in a few years. We need to factor on inflation. We need to make sure that this percentage of the portfolio is secure in case there's a pullback. But 80% of it could still be aggressive. So
right.
again, it depends on the needs of the client, and that's why there's no one size fits all.
Yeah, and I hear a lot of people say, "Well, I'm just going to follow the Warren Buffett example and just put everything in the S&P 500 index because, that may work, that may not work." And again, we covered that in other
Well, and
webinars.
Warren Buffett's a value guy. And even Warren Buffett has said, I don't think I can get the same type of returns that I used to because
Yeah.
there's just not that type of, it's just a different market. So panic attacks,
Oh, yeah.
the average investor just panics. They let politics, they let headlines. As you mentioned, you watch David Muir. Uh, Many people don't. People can choose the evening news now
Sure.
these days. They can go, you know, 30 years ago, 25 years ago, when we all grew up, you had 60 Minutes, you had the same evening news. Everyone was watching the same thing. You can choose where to get your news from these days. And so there's plenty of panic out there, regardless, pandering to one side or the other. I think the point being, don't fall victim to the headlines, the media, the panic attacks, because there's always going to be a reason not to invest. And that's typically when you make mistakes in the portfolio. The average investor returns over 20 years is 3% because they react to headlines, media, politics, and politics matter at the ballot box, not with the portfolio. So I think that that's the underlying theme is just don't panic.
Yeah, and I think I've shared this story on other webinars, but I had a call from a good friend of mine at the time who was a financial advisor, and he said, my client wants to liquidate her entire stock portfolio, an older woman. This was the lowest point of the stock market in 2008. He's like, and he called me like for legal advice, like, do I have to sell all her positions? And I was like, yeah, I mean, you do. And
Mm.
she missed out on that, the following day it
And
bumped.
if you just held 24 months, you would have ridden through it. But
Yeah.
again, that goes back to what's your 2 year, 3 year, 5 year timeline. As long as you've got time to ride through volatility, these short-term trends shouldn't matter. So don't be afraid of all-time highs either. I think that this is a huge,
Hmm.
huge, overly simplified area that people try to say, hey, price earnings ratio is way too high, or the PE ratio is way too high to invest. If you always looked at PE ratios, you'd never invest in a growth stock. You never would. So when has Apple, Microsoft, Google, Nvidia been at a good PE? I mean, Nvidia is driving revenue that's at a 2x multiple of the bulk of the S&P 500 companies out there. So it's not a question of the PE being attractive as a price. It's, do they have the revenue there to continue to justify continued price movement? The PE is never going to be good. So unless you're buying a value stock, I think you need to be not looking at PE. So I think that that's really where people lose sight of PE is just a metric. It's just a division calculation. That's all it is. And so I was talking to a client the other day that said, well, the Dow was down, 500 points. I'm like, the Dow being down 500 points used to mean a lot 2 decades ago. It means 1% today.
Yeah.
The market moves 1% all the time. And so you just got to understand that being afraid of all-time highs and these movements, don't be so concerned with the short-term trends. The market is resilient. If we looked at Time Magazine headlines, if we looked at all the different reasons not to invest, whether it be, the global financial crisis, the Russia-Ukraine invasion, the downgrade of the S&P, Brexit, whatever it might be, there's always a reason not to invest. Even COVID-19, people are like, we gotta get out of the market. If you did, you missed the bounce back that happened within a month that came back 20%. So you just got to stay disciplined and not let headlines drive your long-term plan.
All right, I got to tell you this. If you're looking at this on YouTube, there's a slide that says if you invested $10,000 in the S&P 500 in 1971, which is a really long time ago. I got to tell you, I was talking with somebody in my office getting ready for this who's in her 20s, and she looked at this and she goes, "This just pisses me off. Like I missed out on all this wealth." Um, if that's you, I'm sorry. And if you started investing a long time ago, you're like, "Yeah, this is great." But kind of walk us through this market resiliency, all these things that can happen.
The sooner you invest, the better. Compound interest. I mean, that's the end. That's the name of the game.
And invest, you know what? If you're a grandparent, because we get this a lot with our clients, they say, my grandkids are, I don't know, they're under 10. It's okay to invest for your grandkids. There are smart
Yeah,
ways to do it. There are a lot of trusts you can use in different vehicles so that they don't get all the money when they're 21 and blow it.
sure.
And this is something that a lot of families who create multi-generational wealth and don't blow it, okay?
Mhm.
They tend to be a little bit more open about finances, broadly speaking. And a lot of times it's the grandparents saving for the grandkids because the time value of money, right? I mean, imagine if but by the way, $10,000 in 1971 was a lot of money, okay? So
Mhm.
this is a lot of
Mhm.
money adjusted for inflation. But what a blessing this would be for someone who's maybe in their 50s, right?
Yep.
And the
Yep.
grandparents invested starting in 1971. So if that's you, good for you, good for your family.
This is kind of the underlying theme here too. The impact of being out of the market. If you sit on the sidelines and if you just miss the 10 best days in the market. Look at your average return differential.
This is the 10 best days in a 20-year period,
Mhm.
right? That's
Yep.
what the 7,200 days. You're
If
talking
you
way
missed,
less than 1% of days. Wait.
yeah, if you missed the 10 best days, your average return went from 7.6% a year down to 3.4. Your cumulative return went from 329% total return to 96%. That's just missing 10 days. Now, if you missed 20 days, you're on the sidelines even longer. Your average return went down to 0.8%. If you missed 30 of the best days, and again, these snapbacks happen quick after the market pulls back, they happen quick. And if you're on the sidelines, the missed opportunity is significant the longer you're on the sidelines.
Yeah, this is a great slide. I mean, this is really the argument in favor of staying invested. Um, yeah, great slide.
Yep.
All right. If you're watching this on YouTube, please subscribe to our YouTube channel and please put your comments or questions in YouTube because we actually do answer them, which is kind of cool. I answer them personally, which is something I do quite often. And our office locations for our law firm are in Northern and Southern California. We have our locations listed there. Here's our phone number if you would like to reach out to us. And we'll be bringing this slide back in a couple of slides. Next up, October 17th, is what is the difference between a trust and a will? It's a little bit back to basics, but I think it's worthwhile to go over the basics because if you understand the difference, it really can help you. It can help people that you care about, people that you know. I suppose the people you don't care about, you might not want to tell them if you want them to make a mistake. Again, watch it, subscribe to our YouTube channel. Here's our contact information. We're going to open it up for questions. If you're watching this on YouTube, keep watching because another video magically is going to roll up after this one. Thanks for joining me, Christina.